You closed on a $1,500,000 home in a high cost of living city. The wire transferred, the keys are yours, and every person in your professional orbit, your managing director, your mother, your LinkedIn network, called it the ultimate power move. It wasn't. What you actually did was voluntarily convert $300,000 of deployable, compounding liquid capital into a non-income producing, illiquid, heavily leveraged asset. And then, you celebrated it. Here is the structural reality no mortgage broker will ever put in a pitch deck. The median home appreciation rate in the top 5 high cost of living metros: San Francisco, New York, Seattle, Boston, Washington, D.C. It has averaged approximately 4.1% annually over the last decade. The S&P 500's annualized return over that same window sits closer to 10.4%. You are not building wealth faster by buying. You are building the illusion of wealth while parking your most powerful financial instrument, liquid capital, inside 4 walls that cannot generate a single dollar of cash flow. But here is what makes this trap uniquely brutal for you specifically. The corporate pressure on a high-earning woman to own property is not organic. It is institutional. Homeownership signals stability inside a professional culture. A culture that still, in 2026, subtly codes financial permanence as a marker of executive-level legitimacy, specifically for women. In a way, it simply does not for men. She buys the home, she signals roots, she signals she is not a flight risk. And the system rewards her compliance with a 30-year amortized debt structure engineered to extract maximum interest before touching a single dollar of principal. Run the math on a $1,200,000 mortgage. That is the finance portion, after a standard 20% down payment on a $1,500,000 property. All at today's 30-year fixed rate of approximately 6.8%. Your total interest paid over the life of that loan? Roughly $1,618,000. You are paying for the house twice. The bank doesn't build wealth. You fund theirs. Now overlay the true cost of that $300,000 down payment, the capital you wired on closing day, invested at a conservative 8% annual compounded return across 30 years. That $300,000 becomes approximately $3,018,000. That number is not theoretical. That is the direct, calculable opportunity cost of your down payment. The mortgage complex never presents you that figure. It is not an oversight. It is architecture. This is what I call the liquidity incarceration effect. The systemic transfer of your highest velocity capital into a non-productive, geographically fixed, tax-inefficient asset class. All happening at the precise career stage when your financial flexibility carries its highest strategic value. And here's where the compounding damage accelerates. Beyond the down payment, your $1,500,000 property carries an invisible annual tax on your net worth that most executives never fully account for. Property taxes in high cost of living metros average between 1.1% and 1.6% of assessed value annually. On a $1,500,000 assessment, that is between $16,500 and $24,000 every single year. Extracted, non-negotiable, and generating absolute zero return. Add HOA fees, maintenance reserves, insurance premiums, and structural upkeep. The true all-in annual carrying cost of a $1,500,000 primary residence in a major metro conservatively runs $46,000 per year. That is capital that cannot be deployed into a pre-seed angel round. It cannot fund a self-directed IRA invested in private credit. It cannot sit in a high-yield cash vehicle generating passive yield while you evaluate your next executive move. She cannot negotiate from a position of power when her entire liquidity position is mortared into a property she cannot exit in 90 days. That is not financial freedom. That is a golden handcuff with a Zillow listing. Here is the structural revelation this entire analysis has been building toward. The $1,500,000 primary residence trap is not primarily a real estate problem. It is a geographic leverage destruction event. And for high-earning female executives, the timing of this event is catastrophically precise. Your late 20s through early 40s represent the single highest leverage career window of your professional life. This is when your network compounds fastest, when your equity compensation vests at the highest truncus, When an unsolicited offer from a competitor in Austin or Singapore, or a funded Series B startup in Miami, carries the most transformational financial upside. The moment you anchor $300,000 in a down payment and $1,200,000 in mortgage liability to a single zip code, you have structurally eliminated your ability to act on that asymmetric opportunity. At least, not without triggering a financial catastrophe. Selling a primary residence in a declining or flat market is brutal. Think about it. After accounting for the standard 5% to 6% agent commission on a $1,500,000 property, plus closing costs, and the capital gains exposure above the $250,000 exclusion threshold, all of those fees combined can erase 2 to 4 years of equity accumulation in a single transaction. The actionable correction is not renting indefinitely. The institutional-grade strategy is sequenced capital deployment. A structured approach where you direct the capital that would have entered an illiquid primary residence into 3 parallel vehicles. First, a fully maxed tax-advantaged account stack. That's a $23,500 401k contribution limit for 2026, plus a $7,000 IRA limit. Second, a disciplined taxable brokerage position in low-cost index instruments. And third, a defined alternative allocation, roughly 10% to 15% of investable assets, directed into private equity or angel syndicate structures through platforms that now offer accredited investor access with far lower minimums than a decade ago. You rent strategically in your highest leverage years, you preserve geographic optionality, you maintain the FU capital, that is the liquid position that allows you to walk away from a toxic board, a restructured division, or a compensation structure that stopped reflecting your market value, all without a $1,200,000 mortgage forcing your hand. The liquidity you just preserved by avoiding this trap, that $300,000 sitting in your taxable brokerage, that maxed 401k, that angel allocation, is now generating income across multiple vehicles simultaneously. And the second that income hits your W-2 tax filing, a completely separate extraction mechanism activates. Every dollar you redirect from an illiquid primary residence back into income-generating assets is a dollar the W-2 tax architecture is specifically engineered to recapture through marginal rate compression, FICA exposure, and the systematic elimination of deductions that W-2 earners cannot structurally access. Click the video on your screen right now, and let's dissect exactly how the W-2 tax structure is designed to legally bleed 40% of every dollar you recover and the precise code-based mechanisms that stop it.